future millionaires? Imagine waking up one day to find your bank account has magically grown overnight. Sounds like a dream, right? Well, what if I told you that's exactly what investing can do for you? Okay, maybe not overnight, and it's not exactly magic, but it's pretty close. Today, we're diving into the world of investing, and I promise by the end of this video, you'll feel like you've discovered a secret superpower. So, are you ready to turn your piggy bank into a money-making machine? Let's go. Welcome to our budget blueprint. Today, we're covering the fundamental principles of investing for beginners. Whether you've got $10 or $10,000, these principles will set you on the path to financial freedom. So grab a snack, settle in, and let's demystify the world of investing together. Our first principle is simple but powerful. Start early. And by early, I mean now. Yes, right now. Meet Alex and Sam. Alex starts investing $200 a month at 20, while Sam waits until 40. By 60, assuming a 7% annual return, Alex has invested $96,000, and it's grown to about $524,000. Sam has invested $48,000, and it's grown to about $121,000. That's the magic of compound interest, folks. It's like a snowball rolling down a hill, getting bigger and bigger. The earlier you start, the more time your money has to grow. Remember, the best time to plant a tree was 20 years ago. The second best time is now. Next up, diversification, or as I like to call it, don't put all your eggs in one basket. Imagine you're at a buffet. You wouldn't just pile your plate with only mashed potatoes, right? The same goes for investing. By spreading your money across different types of investments, stocks, bonds, real estate, maybe even a bit of crypto, you're reducing your risk. If one investment tanks, you've got others to keep you afloat. Think of it like this. Diversification is your investing safety net. It won't prevent all falls, but it'll make the landing a whole lot softer. Now, let's talk about the seesaw of investing. Risk versus reward. Generally, the higher the potential reward, the higher the risk. It's like choosing between a kiddie roller coaster and the Mega Looper 3000. One's safer but less thrilling, the other's a wild ride but might make you lose your lunch. Low-risk investments like government bonds are like that kiddie coaster. They're safer but offer lower returns. Stocks, especially of smaller companies, are more like the Mega Looper. They can offer higher returns but buckle up for a bumpy ride. Your job is to find the right balance based on your goals, timeline, and how well you sleep at night when the market gets choppy. Principle number 4. Invest regularly. This is where we talk about the beauty of dollar cost averaging. Instead of trying to time the market, which, trust me, even the pros struggle with, invest a fixed amount regularly. This way, you buy more shares when prices are low and fewer when they're high. Over time, this can lower your average cost per share. It's like buying your favorite snacks. Some days they're on sale, some days they're not. But if you buy a pack every week, you'll get a good average price over time. Plus, it takes the emotion out of investing. No more, should I invest now? What if the market crashes tomorrow? Just set it, forget it, and let time do its thing. Our fifth principle is about maintaining your ideal investment mix. Rebalance regularly. Over time, some of your investments will grow faster than others, which can throw off your intended asset allocation. Rebalancing means adjusting your portfolio back to your target mix. For example, let's say you start with a portfolio of 70% stocks and 30% bonds. After a year of strong stock market performance, your portfolio might shift to 80% stocks and 20% bonds. Rebalancing would involve selling some stocks and buying bonds to get back to your 70-30 mix. This practice helps manage risk and can even boost returns by systematically selling high and buying low. Aim to rebalance once or twice a year, or when your allocation drifts more than 5% from your target. Think of rebalancing like tending a garden. You need to prune the overgrown plants, sell high, and give more attention to the underperforming ones, buy low, to keep everything in harmony. Our last principle is about finding the right balance of information. Stay informed, but don't obsess. It's great to keep up with financial news and understand what's happening in the markets. But checking your investments every 5 minutes? That's a recipe for stress and poor decisions. Markets go up and down all the time. What matters is the long-term trend. So, set aside some time each month to review your investments, rebalance if needed, and then let it be. Your investments are like a bar of soap. The more you handle them, the smaller they get. And there you have it, folks. The fundamental principles of investing for beginners. Let's recap. Start early. Diversify, understand. Risk versus reward. Invest regularly. Rebalance regularly. Stay informed, but don't obsess. Now, before we wrap up, one more principle is all about keeping things simple and effective. Focus on index funds. What exactly are index funds? Imagine them as a massive basket containing tiny pieces of hundreds or even thousands of different companies. When you buy into an index fund, you're essentially buying a small slice of the entire market. Here's why index funds are taking the investing world by storm. Instant diversification. Remember when we talked about not putting all your eggs in one basket? Well, with index funds, your eggs are spread across so many baskets, you're practically running an egg farm. This diversification helps manage risk. Low fees. Most index funds are passively managed, meaning they're not paying a team of expensive analysts to pick stocks. These savings get passed on to you in the form of lower fees. Consistent performance. Here's a shocker. Over the long term, index funds often outperform actively managed funds. Even Warren Buffett, one of the greatest investors of all time, recommends index funds for most people. Simplicity. You don't need to be a Wall Street whiz to invest in index funds. They're straightforward and easy to understand. Tax efficiency. Because index funds don't do a lot of buying and selling, they tend to generate fewer taxable events than actively managed funds. Now, let's look at some popular types of index funds. S&P 500 index funds. These track the 500 largest U.S. companies. It's like owning a piece of the American economy. Total stock market index funds. These go beyond the S&P 500 to include smaller companies too. International index funds. Want to invest in companies around the world? These funds have got you covered. Bond index funds. For those looking to add some fixed income investments to their portfolio. Look at how closely this index fund tracks the overall market. It's like they're dancing in perfect sync. Remember, while index funds are fantastic tools, they're not immune to market downturns. When the market goes down, index funds go down too. But historically, over long periods, the market has always recovered and grown. So, if you're looking for a simple, low-cost way to invest in the stock market, index funds might just be your new best friend. Remember, investing is a journey, not a sprint. It's about making consistent, informed decisions over time. You don't need to be a Wall Street wizard to be a successful investor. Just stick to these principles, stay patient, and watch your money grow. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell. And hey, leave a comment telling me which principle you're most excited to put into action.